I want to thank President Harker and his colleagues, the team at the Philadelphia Fed in particular, for being such wonderful colleagues and allowing us to hold this session here. And everybody wants to hear what President Harker has to say, not me. So why don't we just start the proceedings and have some fun?
Sure.
All right.
Is this, there we go. That's good. So first, welcome to the Philly Fed. We're glad you're back, and we're happy to host this event. It's a great conversation we're about to have. I do have to, though, give the standard Fed disclaimer, right, that the views I express today are my own and do not necessarily reflect those of anyone else in the Federal Reserve System or on the Federal Open Market Committee. And translated, you can say Pat said, you can't say the Fed said. That's the rule. So with that, let's just hop in.
You know, I once traveled around with a guy from the SEC, and he would always give the disclaimer, but he added, "Hey,
You on?
there we go. Is this better?" So I traveled around the world with a guy from the SEC, and he would give his disclaimer as you just did, but then he said, "And every once in a while they agree with me." So a great honor to ask you a few questions. You're the 11th president and CEO of the Philadelphia Fed, and quite apart from your colleagues on the FOMC, you're an engineer who understands automation and might be able to explain to the FOMC a thing or two about innovation and machine learning. And in your distinguished career, you were inter alia the dean of UPenn's prestigious Wharton School and the president of the University of Delaware, and thus you must undoubtedly be a big Quaker and Blue Hen supporter.
And we're not the fighting Quakers, we're just Quakers, so that makes no sense.
So whenever an FOMC member is interviewed, the first question is asked for a thumbnail sketch on your outlook for the economy, inflation, labor markets, monetary policy. So let me be very predictable and just sort of
all the above. Yeah, you step back and you look at the economy, it is incredibly resilient. The one thing that I think about is, again, that word resilience, that despite everything we've been through and continue to be through, this economy keeps chugging along. Yes, we have high inflation, and that high inflation is really a scourge, particularly on low to moderate income communities in the country, and we've got to get it under control. We're committed to get it under control. But to do that in a way that does not damage this economy that just keeps moving along. You look at the labor market, and we'll get another read on Friday about the labor market, which will factor into our thinking, my thinking. But, you know, I am not predicting at this point, we're not predicting as a team here in Philadelphia that we'd head into a recession. That's not our modal forecast. It's always a probability, but that is not our modal forecast. So we're looking at, you know, GDP moving over the next couple of years back to its trend growth rate of 2%. But it's going to take some time. Unemployment is going to tick up. It's probably going to tick up, at least in our forecast, over the next years to where we think the long run average is, around 4.4%, say, something like that. And then inflation is going to take some time to come down. But we are seeing signs that it's moving in the right direction. It is stubborn, though. And some of that is that we still have some supply chain issues. We still have some other issues, particularly labor issues in the economy, but it is moving in the right direction over time. But it's going to take time. And I think we have to recognize that. And so we cannot, you know, try to slam on the brakes really hard, in my view, that it's not, that we're getting close to a point where we can sit for a little bit in terms of policy. I don't know if we're exactly there yet, but I am in the camp increasingly coming into this meeting of thinking that we really should skip, not pause. I don't like the word pause, but skip an increase. Now, again, I think if we see the labor market data on Friday and then the CPI report come out, that may change my mind, but I think even there, we got to look through one particular FOMC cycle, one particular month. And we've got to get to a point where we have policy in where we believe it's restrictive. And I think we're close, if not at that point right now. And so I think we can take some time. And so I'm not saying that we're not going to continue to tighten. I'll be very clear on this. But I think we can take a bit of a skip for a meeting and frankly get back to, if we're going to go into a period where we need to do more tightening, we can do that every other meeting. We don't have to do it every meeting. I mean, that was kind of the normal pace that we would follow, except in this particularly unusual, what I think the economists called weird economy, that we can take our time. So I am definitely in the camp of thinking about skipping any increase in this meeting, barring what we see in the next few days, and then letting that ride for a little bit and see how we go.
Thank you. A skip, not a pause.
A skip. Because it, you know, that I think it's important that a pause says we're going to hold there for a while, and we may at some point hold at a place for a while, but I don't know that yet. And so I think we have to be ready that we might have to do more in subsequent meetings. And I'm fully aware we have to do that and willing to do that, but I want to give it a little bit of time.
Okay. Well, maybe we can dig down a little bit into some of the things you were talking about and starting off with inflation, because the headlines come down, but the core seems sticky and stubborn, as you said. And I see all the data trimmed to this, ECI, services, sticky, et cetera, core, super core. And I get confused by it all, but I just kind of say, well, inflation seems stuck in the 4 to 5% range, which is far, far away from 2. So you cited a few factors, but what's your assessment of the persistence of inflation, and how do you see it evolving a little more thoroughly?
So it really, at the end of the day, comes down to service inflation, and particularly core service inflation. We're already starting to see the housing inflation come down. It's working through, right? Just mechanically working through the measures. But we're seeing real-time data from Zillow, et cetera, on rents, that they are starting to move in the right direction. So housing seems to be moving, again, to where we'll get to a lower rate. But it's core service inflation that's really driven by labor. And it's a labor issue that is driving that, in my view. We are seeing some signs, and I emphasize some signs, that the labor issue is getting better. When I talk to our contacts and through the survey work we do, it is definitely easier to hire. We're finding it's easier to hire for ourselves at the Fed. It's getting easier to hire IT talent, auditors. You can go down the list. It's just the markets are cooling off. And as a result, when we talk to our contacts, we're not hearing what we were hearing a few years ago, where they're doing mid-year salary increases. They were doing all kinds of other things, buying people gasoline cards, and to get a whole host of things they were doing to try to get people to work. We're just not hearing that right now. It is cooling off. It is sticky though. It's taking some time. I mean, we have long-term demographic trends we can talk about that are holding back labor. We had those before the pandemic. We still have those now. Nothing's really changed there in terms of other than we, the boomers, accelerated our retirements. But we really had continued long-term labor issues. So some of the factors that are keeping core service inflation up do seem to be abating. There are still some supply chain issues we're hearing about. They're not as severe as they once were, but they're episodic. There's some issues that show up from time to time. But it's not really so much the goods inflation right now that's the driver, right? It's that core service inflation. So that is something I'm watching carefully.
Okay. I mean, services are about 80%.
70,
yeah.
But
okay, on labor markets, you said you see signs of slowing, but I was just read that the job openings were up in April.
Yeah.
And unemployment is 2.4. So it seems if you have good employment numbers, then you're likely to have decent disposable income.
Yeah.
So, as you said, the economy seems to be performing relative to
Yeah.
expectation. There are those that will argue that significant slowing in the labor markets and the economy was needed to cool
Yep.
inflation. I've heard you push back a little bit on this, but
Yeah.
could you elaborate on whether you agree, disagree, or why, and how much?
Yeah. So I
slowing
mean,
is-
do we need slowing of the labor market? Yes. That's why we're predicting unemployment going from where it is now to 4.4%. How much, that's back to really long run trend, right? We were, again, below that trend before the pandemic hit. There are these structural issues in our economy, just not enough people, whether that's immigration policy or other policies inhibiting people's ability to work, they were there, they're still there, they haven't gone away. But that's outside the world of monetary policy to address that, right? But they are there. I mean, one of the areas that we're focused on here in the Philly Fed through our community development work is really understanding the child care issue, right? In the state of Delaware, it's $20,000 per kid per year for child care. If you got 3 kids, somebody's staying home, nobody and not going to work. They're working, but not working, right? In what we measure as work. So, I mean, those problems haven't gone away. I do see that we need to cool the labor market, but I don't think we have to crush the labor market to get inflation down. Because the goal is not to dramatically drop inflation right to 2%. It's to move in the right direction and to start to, and we're seeing groceries are starting to get a little better. And some of those, those issues have nothing to do with monetary policy. Eggs were about an avian disease, not about monetary policy. So there are those things that are going to hit from time to time. But generally, I think I am in the camp where we don't have to crush the economy to drop inflation dramatically tomorrow. We can take a little bit of time, get it moving in the right direction. I think we're there. We may need to do more, but we'll let this play out for a little bit before I at least want to support another increase.
So, well, that ties into a question that I was going to ask you, because I have seen forecasts next year or goes down to 3% or so, but then some of the analysts argue, well, getting from 3 to 2 is going to be a lot harder than getting from where we were to 3, and that there is going to have to be sacrifice. And others have suggested, well, the Fed shouldn't fall on its sword getting from 3 to 2. It's a bit hypothetical, but people talk about the last mile. How should a data-dependent Fed approach the last mile?
So first, you start with our monetary policy framework, the new framework we put out. So we need to get in the range of 2. We don't need to hit 2, right? And so what that range is, I think each policymaker will make their own judgment of what is close enough. For the sake of argument, let's call it 2.5 to 1.5, right? That's 2. We can argue over what that number is, and we will argue over what that number is exactly. But we need to get in the range of 2. It may be sticky, but you look at some of the trends that and drivers that might keep it up at 3 instead of 2. Fiscal stimulus. Well, I don't see that in the cards in the foreseeable future, right? Given where we are as a country. There is money that is going to be spent on infrastructure and so forth over time, but it is going to be spent at a certain pace, and it just is not going to affect, the homeowners or ability to buy a bigger house or buy, this or that, or to consume more goods or services. So I just don't see that as a driver anymore, fiscal stimulus. So, what's then going to happen? Well, I don't know. I ask myself, we were talking about this earlier, what has fundamentally changed in this economy after the pandemic? I think about that a lot. Again, there's some labor movement. There's a little bit of scarring there. There's going to be scarring around commercial real estate. But generally, what has fundamentally changed from where we were before the pandemic hit? I can't pick up a lot of big things. And so again, go back to where we were. Low inflation, low unemployment. That's where we were. We were struggling to get inflation to 2%, right? We remember those days. Those days are hard to remember sometimes, where we're seeing the devastation that high inflation is causing. But, I just don't see why we couldn't get back to close to that range again. What is structurally so different in this economy that would stop us from getting to that point? The one thing that you would worry about is if inflation expectations get unanchored and then we start a spiral. Again, there's no sign of that right now either. So I think we just need to, it is possible it's going to take time to go, say, from 3 to 2. But as long as we're moving down and getting in the range of 2, I'm fine with that.
Okay, mean reversion, R start, and all of that. Okay, the Fed's rate hikes have slowed credit growth, perhaps not as much as expected. The senior loan officers review the survey didn't necessarily show abrupt credit tightening. There are worries about commercial real estate vulnerabilities in the economy.
Yeah.
So what's your take on credit? Too hot, too cold? And should we take the view that the latest banking woes, Silicon Valley Bank, First Republic, et cetera, are helping the Fed do its job?
So on the credit is another area where, again, it is going to help us in terms of slowing inflation. What we're hearing from, let's start with what I'm hearing from all the contacts, all the bankers I talked to. It's not a credit crunch, it's a little bit of a credit squeeze, right? Their first reaction, it's natural, is to focus on their existing customers, right? And continue to give them the credit they need for their businesses. That's natural. And really turn away from some new customers. So that's going to create a little bit of a squeeze. I'm not seeing a dramatic credit crunch. I agree with the slew. But I do think that we'll see a little bit of credit contraction, which again will cool things. But on the broader issue of the banking sector, it still remains very strong and resilient. And so again, there are things that are going to happen within the banking sector. There's going to be merger activity. I mean, it's pretty clear that that's going to continue. But I don't think we're going to see anything like we've seen in the past few months.
Okay. Well, let me ask the last question, and then I'll turn to audience questions. But I discussed at the beginning your unique background, and you're in the FOMC as an innovator, an engineer, somebody who understands AI, which makes you a very distinct person. So what insights does that background allow you to bring to the FOMC, and that can help them monitor?
So let me ask ChatGPT right now. I'll find out the answer. This technology is going to be quite important, but it's been in development for a long time, right? So I do think that it will have an impact on the economy. Now, there's going to be a big question, right? And this is a question that economists have debated now for a long time. Gordon's book, is it going to be radically change the productivity of the global economy, the U.S. economy? We'll see. I mean, if you believe Gordon, the last big innovation was electricity. And but if you take Eric Brynjolfsson's view, very different perspective, right? That we just don't measure it well. And, Leonard Nakamura and people here at the Philly Fed have done research on this. And, it's important stuff whether we're measuring these things correctly in a very different kind of economy. That said, technology is running. I'm not a Luddite. Maybe it's my background, but I'm not a Luddite. We have to manage technology, but you're not going to stop it, right? And there's ways of managing it. And we can harness this for better use of all of us. But it's not just AI that's coming down the line. For example, we in the Philly Fed here on the AI machine learning front, we've actually invested in our research department and some researchers that are trying to bring machine learning techniques into economic modeling in a pretty profound way in some ways. That is how my own background of understanding that technology, trying to bring that into a different way of thinking about economics. Because our models, while elegant, are not very predictive, right? And lots of things are going on. And they're not very predictive because it's a very complex system we're trying to model, a highly complex system we're trying to model. But maybe there's better ways of doing that. And that's what we're trying to explore through our research. But there's another technology coming out that is also could be quite revolutionary. It's not just AI. And here's an area where we are also investing here on the part of the system, the overall Federal Reserve system, and that's quantum computing. Quantum computing is within a decade, most likely, of becoming reality. And the machines, the reason I'm interested in this is a really twofold reason I'm interested in this, and we as a system are interested in this. First, it's going to change all encryption. All encryption we know has to be replaced. And so quantum safe encryption is going to be something that everybody's going to have to do, and that includes the banks we supervise. They're going to have to put in place a whole different encryption model. And the thing is, the current thinking, at least from the National Institutes of Standards and Technology that we partner with on some of this, is that they don't know exactly what encryption algorithm will work. So you're going to have to be more of a plug and play kind of system of plugging in and out an encryption algorithm. Think about all the systems we run all over the world. All that's going to have to change. But there's also a use for modeling as well. I mean, there may be much better ways of doing Monte Carlo simulation with a quantum computer, much faster. So we can do much more detailed and precise stress test modeling, multivariate stress test modeling. There's a host of things that we can think about. And so we're actually starting to explore those too, with a little bit of a sandbox in the Fed to just explore how that technology can be used. But it is one that is absolutely coming at us. But back to AI, let me finish on that. And I want to go back to Eric Brynjolfsson and his book. He wrote a book back in 2014 with McAfee that was called The Second Machine Age. This is a while ago, right? And they make the point in that book at one point, they talk about productivity, technology, so forth. They make the point that there's still a role for human beings. We're not going to be the Borg on, Star Trek. That there's still skills that we have that are uniquely human, that technology is going to have a hard time replicating. And they articulate those in this book. It's 10 years later, technology's changed. But what we need to do is double down on those things that humans do uniquely well. And I put my old educator hat on, and that's what we need to do in the education system. We need to really double down on that kind of complex thinking, that kind of very human forms of communication and leadership. Rote stuff that you can look up, well, those days are gone, right? But we need to change, we really need to change the way the young people who are being educated think, and think in a much more complex way, and aided by these tools, these AI tools. And we shouldn't be afraid of it. We should embrace that and be willing to embrace that change. That's going to be hard. Like the education system isn't all, particularly higher education system where I come from, is not always amenable to that, but it is something we're absolutely going to have to do, because you're not going, once we start using these tools, we're not going to.
Thank you for that. I can see in your citation of books and your discourse on that subject, it's a true passion of yours.
Yeah. Yeah. I mean, this stuff is coming, and we need to figure out how to use it, in the case of the Fed, to help us do our job better, right? To just create a more stable economy. And I think there's some tools there that we can use that could be efficacious.
Maybe we'll figure out an algorithm that'll tell us what the Fed funds rate will be.
Yeah.
Any questions from the audience? Let's see how many. One. My goodness. All right.
Now we're being live streamed, so please use the mic when you ask the question.
Absolutely. And I frequently just take 3 at a time. I don't know how much time you have. So I'm going to start this way and go this way. So did you?
Yeah.
Please.
President Harker, thank you for your comments. I was curious to hear your thoughts on the neutral rate, given what you just said about productivity, but counterbalancing it earlier with your thought that nothing has really changed pre-COVID. So where do you think the neutral rate is? And do you think that it is in any way, shape, or form different than where it was in the past? Thank you.
That's the first one. Let's keep going down this way. Everybody, over Dave.
Hi. So my question was more around what happened with some of the regional bank collapses, and one can say that was a result of some monetary policy changes. But how does the Fed think about some of the other large institutions, given that the cost of funding is going up, deposits are leaving, and do you view that as a concern in terms of the lending that's going on in the market, be it small, medium-sized lending or commercial lending, where they're probably some of the biggest providers to some of those local markets?
Great question, David. You're the end of this first.
Would
Actually, David.
All right. Yeah. Sorry, it will be your turn very soon, I'm sure. I was wondering from a market perspective, we've seen a lot of volatility in terms of what is priced. So the 2-year U.S. Treasury yield has been kind of all over the place, going 10, 20 basis points up and down, and there has been a bit of criticism by some that the Fed has kind of fueled some of that volatility, which from a real economy point of view probably isn't very healthy or helpful. Would you view that as just an inevitable kind of thing in this current situation, or is there an argument to make that yes, maybe communication could be improved in some areas?
Okay, so
First one was neutral.
yeah,
rate.
so on the neutral rate, it could change, but often the best predictor is what happened in the past. We see this with inflation, and so I don't know. I mean, that the jury is really out on that. So, but if it changes, it's going to change over decades, not over a couple of years or a year. I mean, this technology takes a long time to filter through. You look at any technology adoption S-curve, you're talking 20+ years. So on the banking crisis, Vice Chair Barr has released a report. We need to understand what happened, whether there's has to be some changes in how we look at things like regulatory capital and what's in and what's out. That's obviously in the hands of the Board of Governors, not in regional banks. There is pressure under the regional banks. I'm a little concerned right now that if, knock on wood, we get this debt ceiling crisis behind us, Treasury will be issuing. There is going to be some potential, and I emphasize potential, movement of liquidity out of the banking system. And how much, we don't know, but it's something that we have to be very careful on. And the last question, on volatility, I think the best thing we can do at the Fed is to try to create stability in our policy. And that's why I'm in the camp of getting up to a point that is clearly restrictive and holding for a while. I'm willing to skip here if we're not at that point, but at some point we've got to just sit for a while and let things work. And so we shouldn't be adding to that volatility in my mind. We should just have stability at a rate let things go for a while, let the data evolve, let the economy, let the inflation cool. And at some point in the future, and we're not predicting this year, by the way, we start to bring rates down. I think we just need to hold. So I don't want to add to that instability.
Okay, let's take three more. So I see two flags up. Any others? David?
Yes, you seem to be outlining a move to what you might call a kinder, gentler Fed. How much of this would you say is down to paying some regard to social consequences of higher interest rates? You mentioned you don't want to crush the labor market, and then you didn't mention the war in Ukraine. Is this slightly more compliant attitude, a slightly more patient attitude, also perhaps a reflection of the fractured world system? You don't want to pour oil on troubled waters. And in the light of all that, would you have anything against what I call the 3-4 syndrome, which is to have inflation of 3 to 4% over the next 3 to 4 years? What's wrong with that?
Patricia?
I just wanted to come back to your points about all these new tools and technologies, from AI to quantum computing. A lot of innovation is going on in the financial sector and also outside the financial sector with regard to financial services. And one of the biggest challenges for those participating is to understand what is permissible and what is not. And right now, there's not a lot of clarity in the regulatory world around some of these newer asset classes like digital assets. So I'm just curious how you reconcile the support of innovation while regulating, new frontiers and new products.
George, you get the last question.
One of the salient aspects of this expansion is the very high ratio of job openings to unemployment. And I'm just wondering how we should think about that in equilibrium. What is sort of an equilibrium position for that?
And can I pile on David's question? Much the main issue. If you had any thoughts for us on this discussion that we see internationally about fragmentation and the economic costs for the United States.
So the particular issue of Ukraine, this incredible tragedy, the horrific stuff that's going on, it adds just to the volatility that we're facing in the markets, because we don't know, there could be a worst case scenario. God forbid the worst case scenario that happens there. So yeah, it's adding to people's angst, and that angst gets reflected right in the broad volatility that we see. 3-4%. One thing that I kind of learned in 8 years here at the Fed is you got to look beyond the headline inflation number and look at what exactly we're talking about, right? So you could say, well, we could live with 3%, that's fine. But if that means food, shelter, and energy costs are really high, that crushes the low income to moderate income communities. So could you live with that? Well, if it would, I'm not in that camp. I think we do need to get down to 2%. That is our commitment, and that's what we need to do. But even if you wanted to be in that camp, you'd have to really look at the components of that. Because if it really is, if people can't find a place to live and they can't drive to work, and we just did interviews of what we're calling the Worker Voices Project, where we actually listen to workers and why they're not going to work. And that's, I'm going to come back to that. And one of the things one guy said is, yeah, it costs me 2 hours of wages to drive to and from work. In 2 hours, that's the way he translates it, right? 2 hours of wages every day to drive to and from work. That's killing me. So it really depends, I think, on what those components are. On the new technologies and innovation in financial services, we shouldn't stop that innovation, but there has to be a regulatory framework. And that regulatory framework at the end of the day doesn't come from the Fed. It's got to come from Congress, right? Because it's not clear. We do a big fintech conference every year here. And it's not clear who's in charge of different, because it's not just, digital assets. It's what type of digital asset it is and who would regulate it, and whether it's whether it's a stable coin that looks a lot like a money market fund, and that would fall in the SEC. That's not our decision to make. That's really ultimately Congress's decision to make. And I hope they do it soon to clarify some of what we're seeing, because it is causing some confusion. Last, the openings. Why are we having these openings? Well, there's a couple things. One is we do have, overall, if you just look at the macro issue, we have just boomers retiring. We've got a generation coming in that is smaller. We don't have an immigration policy. And again, I'm going to triple down on my disclaimer. It's not my job to tell somebody what the immigration policy is, but we don't have an immigration policy really. You know, so there's in this, you listen to the Chamber of Commerce, you listen to every business leader, they're just pleading for clarity around this, right? Pleading. I had a guy who last summer, a landscaper I heard about in the central part of the state here in Pennsylvania, he had these workers coming on temporary visas, but they got there late. They got a couple months late. And so he was putting down mulch in August on people's yards here, and they were complaining by that point, the weeds have all grown and I don't need the mulch anymore. He couldn't get the workers. So the immigration policy, not even for permanent residents, but just temporary work visas, we've got a real problem. We've got to back, the systems are antiquated, and we've got to solve this problem. But that leads then to the last point I'll make, and why we did this Worker Voices project that we just issued this report. It was a system-wide effort that was really led out of Philadelphia. You know, employers couldn't understand why they're not getting the workers. So what we did is go ask the workers. We asked across about, I think it was 33 states, 147 zip codes, people who were in work training programs or affiliated work training programs, what was going on? Why weren't they taking the jobs? Why they were not working, but they wanted to work. You know, and some of them wanted to upskill. They didn't, you know, they didn't want the job they had. And frankly, the pandemic gave them a little bit of breathing space to get the skills necessary. That's why they're going back to workforce training programs to get a better job. But one word, because I met with a group here that came after the report was done, we wanted to bounce off of them what the findings were to get their reaction. And the one word I heard, whether it is directly articulated or indirectly articulated, was dignity. It's not wages. Wages are part of it. Now, yes, employers is wages, but you ask the workers. And there was one woman there in particular, she said, I have 2 kids. I don't know what my schedule is, you know, day to day. I can't do this. I've got 2 kids. I need to have some stability in what my schedule is. And my boss just doesn't get it. And this is consistent with what you know about labor markets and management of human resources. That after wages, the number one reason people leave a job is their manager. Their manager. Though they're often willing to take a lower paid job to get a better boss who understands what they're going through. And remember who we're talking about, low wage workers, these service workers. That's where the service inflation is. These are people who are working 2, 3 jobs, and they just want some stability and some understanding, childcare being part of that. I mean, there's a whole host of reasons. So yeah, we got a lot of openings, but we had tight labor markets before. Again, these were problems that weren't new to the pandemic. They were just accelerated or exacerbated by the pandemic. Those are the things way outside of monetary policy. It's not just about wages. You can increase the wages, but if somebody still can't get somebody to take care of their kids, what does it matter, right? It's not going to move the needle at all because the cost of childcare just went up because the wages went up, inflation went up. So this is why we got to get inflation under control. Part of this is getting inflation under control, get these other policies outside of monetary policy, right? Because ultimately, let's face it, it's a supply-demand issue. We can affect demand of labor, but the supply of labor is also important. And it's something that we need to address societally, not just, it's not in the wheelhouse of the Federal Reserve to do that. It really is in the wheelhouse of Congress, local governments all across the country, coming up with creative solutions to solve these problems.
Fantastic. Well, thank you for spending
Thank you.
so
And
much
thank you for
time.
coming to
A
Philadelphia.
huge round of applause for President Harker.